morning. This is Business Morning. Thank you for joining us. I'm Chimeze Obi Iwagu. Teeing off from the global oil market space as prices dropped this morning, reversing gains in the previous session on concerns over whether major crude producers will be able to agree to extend record output cuts, heightened by worries over a huge build in U.S. distillate inventories. Brent crude futures fell 1.46% to $39.21 a barrel, while U.S. West Texas Intermediate crude futures slid 1.98% to $36.55 a barrel. Saudi Arabia and Russia, two of the world's biggest oil producers, have agreed to support extending into July the 9.7 million barrels per day in supply cuts backed in April by the OPEC Plus group, comprised of the Organization of the Petroleum Exporting Countries and other major producers. But they failed to agree on holding an OPEC Plus meeting on Thursday to discuss the cuts, with OPEC sources saying it will be conditional on countries that have not complied with their targets so far, deepening their cuts. Further, Saudi Arabia and other Gulf producers, Kuwait and the United Arab Emirates, are not planning to extend voluntary additional output cuts of 1.18 million barrels per day after June, indicating crude supply could rise next month no matter what OPEC Plus decides. The huge build in distillate inventories in the United States, the world's biggest oil user, also weighed on prices. Overall, demand for diesel and similar fuels is down 13% from the year-ago period over the last 4 weeks. All right, joining me now to look at the latest development in the oil market is the head portfolio management at Commercial Partners, Victor Aluyi. Good morning, Victor. Thank you for joining us.
Good morning. Thank you.
So what do you make of the volatile trading we've seen in the oil market lately? Yesterday, Brent went up as high as $40 and eventually tapered after the hope of an OPEC Plus meeting seemed to have been dashed.
I think crude oil has essentially benefited from, renewed optimism, particularly around, the easing of lockdowns globally and the potential impacts on price. So we've seen crude oil, gain over 100% since its lowest points early in April. In the month of May alone, crude oil was up over 50%. So we've seen crude oil on the ascendancy, and that's pretty much been on the back of the supply cuts that, OPEC Plus had implemented starting from, the beginning of May, and also the demand recovery, if you will, that is expected on the back of the global easing of lockdowns that we're seeing. So that's the reason we've seen that significant run-up in crude prices over the last couple of weeks. Again, the expectation, particularly around, supply cuts, is that OPEC Plus would extend those cuts of 9.7 million beyond June. Recall that 9.7 million barrels was agreed to take off the crude oil market between the month of May and June. From June to the end of the year, that was going to reduce to about 7.7 million barrels. So what OPEC Plus is trying to do now is to extend those cuts of 9.7 million barrels for an additional 1 month to the end of July. There are some hiccups around that potential agreement, and that's the reason we've seen, some pullback in crude prices this morning.
Well, oil prices have been pretty firm this week, and of course looks relatively set to continue to rise irrespective of certain circumstances there. What would be the implications of the rise in crude oil prices across the securities markets globally?
Well, so for securities and for countries that are commodity heavy like Nigeria that depend a lot on crude oil, it's been positive. We've seen that positively impact foreign debt papers. We've seen that also positively impact the foreign debt papers for a country like Angola, who's also largely dependent on crude receipts. We've also seen that filter through to the equities market and created some sort of positive sentiment and momentum in that space as well. So for countries that are oil heavy, if you will, generally positive sentiment for them. But again, down the road here, there seems to be some headwinds that we need to look out for. So yeah.
Now, looking at the Eurobonds of oil-reliant countries, the recent spike in price of Brent has been fueling demand on their sovereign Eurobonds, sending yields on a slope. How positive is this development for the issuers, including those in the private sector segment?
Well, so for the private sector, we really haven't seen much of an issuance really within this period. For the sovereign papers, like you mentioned, what we've seen is very, very strong positive sentiment, particularly over the last 2 weeks. We've seen yields decline across the Nigerian curve by over 70 basis points. If you look at the Angolan curve, you're looking at over 200 basis points. So it's been very, very positive for the oil-heavy Eurobond debt issuers. And, it continues to be so. However, we're likely to see intermittent profit-taking here and there. So that's how the market is likely to continue to play this.
Let's narrow this down to the revised benchmark crude oil price in Nigeria's budget, which was hiked by the legislators from $25 to $28. What do you make of such move, considering the level of volatility lately?
Well, I think it basically hinges on the fact that there have been some positive sentiments in the crude oil market lately, and the belief is that that positive sentiment is going to continue to carry on for the better part of the year. The idea, again, is that the worst of the storm has passed. We are pretty much out of the woods right now, and I think that's the reason we saw that sort of revision. The idea, again, is to help sort of show up government's revenue expectation, if you will, and then maybe by extension, sort of like reducing the sort of, expected deficits as well. Again, these are just numbers that would provide sort of guidance. At the end of the day, the reality would set in, and I'm sure that fiscal authorities would adjust as necessary.
Talking about guidance there, in terms of production, now the lawmakers have cut the output to 1.8 million barrels per day to 1.9. Is this still within the realistic band?
Well, if you add on the, distillates, it becomes sort of realistic. If you look at the OPEC cuts that were agreed on in April, started implementation in May, our output should go to somewhere around 1.4. But again, if you add condensates on there, we're probably looking at about 1.7. Again, these numbers are there to sort of provide guidance. If you look at the Q1 numbers that we saw, very strong production. So again, we'll see how that pans out with regards to production, particularly for Q2.
Now, what's your projection for prices for the rest of June?
I mean, that's really tough to say. That's one of the toughest things to do to make, projections around crude prices, because the market remains very volatile. If crude prices continue on the ascendancy, you are likely to see, shale producers get back on stream, and that could then begin to undermine the output cuts that OPEC is implementing. So really a lot of factors to look out for on how, the oil market dynamics would evolve. Very volatile. So it's really tough to say where these things are, where the price is going to rest. But I think that with the global easing of lockdowns, with the recovery in demand that is ensuing, we could see crude prices average, the high 30s for the better part of this year.
Now, in terms of FX inflows from Nigeria's sale of its Bonny Light, Kwaibo, and other variants generally, what are your expectations as it relates to accretion in the external reserves?
Well, this is going to be positive, for external reserves. Recall that when crude oil dropped significantly, reserves were around 33 billion. Over the last month plus, we've seen some accretion to reserves. And as crude prices continue to remain sturdy, we're going to see continued accretion, to reserves. So this is clearly very positive and will continue to support, the reserve position. I'll also continue to help in managing the FX situation and ward off a potential further currency devaluation.
Now, if you look at the investors and exporters windows of the FMDQ, there's been some kind of scarcity of the dollar and other key currencies, putting more pressure on the naira. What does that tell you about dividend or investment repatriation weeks after the CBN governor guaranteed investors of security of their investment?
Well, I think for me, it's reflective and also very indicative of the fact that we're probably not seeing a lot of liquidity coming, particularly from the Apex Bank. Over the last couple of months, the Apex Bank has remained the biggest player in that market in terms of providing liquidity, because we haven't seen much of inflows coming from offshore guys. So clearly, I think the Apex Bank isn't playing much there in terms of liquidity, isn't providing much liquidity in that market, and that's why you're seeing that sort of pressure. I think the bank has its own priorities in terms of how it wants to deal with the FX situation. So, but clearly not much liquidity, and that's why you're seeing a lot of the foreign funds are still pretty much playing in the markets because they are unable to get out at this time. So I think that's what that basically reflects to me.
So how critical is the gradual reopening of the global economy to these demand for crude oil?
Well, I mean, like we said earlier, it's one of the key factors that have driven some sort of recovery in crude prices, really. So, as the global economy continues to reopen up, as lockdowns are eased and that becomes even more widespread, we expect demand recovery to remain on track and continue to improve, and that will also continue to provide support to crude prices. However, like I said earlier, as crude prices continue to rise, you are likely to see shale producers, come back, into the fray and, start to ramp up, and that could have implications for, the supply dynamics in the global markets.
Now, in the event of a relapse in cases of COVID-19 globally and there's need for a kind of a reversal of the reopening of the economy, how would the markets discount such scenario?
That would be a pretty devastating occurrence, really, and that's for me probably the major risk on the horizon, the possibility or the potential for cases to increase again, and then we go into another phase of lockdowns. It'll be tough to really say how the markets will probably price that in, but that would be significantly negative for the markets. We're probably going to see, asset prices significantly repriced, particularly risk assets, significantly repriced downwards, even at a whiff of the possibility of, cases rising again and lockdowns coming back on. So clearly that's a major risk issue that we'll continue to watch out for and hope, doesn't come to fruition.
Well, let's just hope so. Thank you very much, Victor, for your time. Victor Alui is the head portfolio management at Commercio Partners. All right, still on the world of commodities, Damilola Kimbami, head of research at Financial Derivatives Company, is here with me. Hello, Dami.
Good morning.
Thank you for joining us. Well, what is this about Nigeria and Iraq being called out for output busting?
Well, the two countries have been identified as some of the underperformers in terms of adhering to their OPEC quota. And according to data...
Like they are pumping more than what should?
Yes.
What they are supposed
exactly. So each country has a quota. So for instance, Nigeria's own was revised downwards to about 1.45 million barrels per day. And we're still producing about 1.7 million barrels. So our compliance level is about 19-20%. Iraq's own is about 23%. So definitely those two countries, it's clear that we're actually not adhering to the compliance level. And if you look at OPEC as a whole, total compliance level has been around 77%. And actually, because of that performance from other members, that's what actually, or one of the reasons that contributed to the increase in oil prices. And you can imagine if Nigeria and Iraq also met their, or adhered to the compliance level, most likely we'll be seeing maybe 100% and a further increase in oil prices.
So with this development and Nigeria and Iraq not complying to the OPEC quota, what will this development mean for Nigeria?
Well, for Nigeria, the government most likely would say that, okay, maybe it has some obligations that are due and that it's why it's yet to adhere to it. And the thing is, if OPEC insists that you guys have to adhere to your quota, you have to comply, then the government will be forced, or NNPC and all the oil producing companies will be forced to bring down their production levels. And bear in mind that the Senate recently cut down the benchmark production levels to 1.8 million barrels per day from 1.9. That is still in excess of our quota. So more needs to be done, and it will have negative implications for our revenue profile. Oil prices, yes, have been inching up. That's currently above the $28 benchmark the Senate approved, close to 40. But then still, Nigeria is more production sensitive than price. And if we are being forced to comply, it's going to affect our revenue position. Our deficit financing would have to increase. We're aware that about $5.5 billion has been approved for external borrowing. Borrowing is not a crime. Most countries...
But it's what you use it for.
Exactly. It's what you use it for. And again, for Nigeria, you have to be careful that you don't fall into a debt trap. And we know that the currency has been experiencing some weakness. It was devalued in March. So the problem there for Nigeria and even a lot of developing countries that are seeking for bailout funds and moratoriums on their outstanding debt is the fact that if the recovery doesn't occur as soon as most people are expecting, you could fall into a debt crisis. And more importantly, because your currencies are weakening, you have a currency crisis. You have a currency shock. Because now what you are paying, because your loans are in dollars, and because your currency has, the exchange rate has moved against you, you are going to be paying more. Your debt service payments would also increase. So that's actually the concern there when you borrow externally.
Well, I'm sure you heard Victor. He says that the 1.8 million barrels
Yes.
being approved by the Senate is quite realistic, and then of course the $28 still quite realistic.
Well, you have to understand that the oil market is quite volatile. We know that Saudi and Russia, to an extent, they've agreed to extend the 9.7 million barrels by 1 month. And that is conditional on Nigeria and Iraq adhering to the compliance level. There are also a lot of factors that are at play right now. There's the US-China tensions, which is still ongoing and is depressing prices. There's the issue of Russia also saying that it's likely to, or it plans on easing its supply cuts as from July. So the fundamentals are still in favor of an oversupplied market. And if that happens and OPEC clamps down on defaulters of the quota, then Nigeria may have no choice but to bring down its production levels. And everyone wants oil prices to increase, especially Nigeria, that depends significantly on it. We know that the FAC disbursements that were shared in May were lower compared to April. And June, what was going to be shared in June, fine, oil prices improved in May. If FAC continues to decline, state obligations will be difficult to meet, salaries also. So Nigeria definitely needs some improvement in oil prices.
Well, the Senate is also calling for the scrapping of the excess crude account. What about that?
Yes, so the excess crude account, what goes into the excess crude account is your savings. So the excess from what oil prices are trading at and your budget benchmark price. So if the budget benchmark is at 28, and let's assume that oil prices are at 40, so that difference of about $12 usually goes to your excess crude account. But now that that has been scrapped, so basically you have more money to spend. And that's what the government is saying, okay, fine, we have a lot of outstanding projects because of the coronavirus.
But do you think that's the right move to make at this time?
At this point in time, you have to be flexible. You have to. It's not a one-size-fits-all scenario. And if a particular strategy is not yielding the desired outcome, nothing stops you from going back to the drawing table and revisiting what you have already proposed. At this time, yes, there are a lot of outstanding projects. Yes, the government needs to stimulate the economy. You have to invest in projects that would yield investment gains, because that is actually what would trigger the necessary growth and development.
All right, let's relate this to other domestic commodity markets. What are their implications?
Okay, for other commodities that are ongoing, especially like our exports and imports, the dynamics is still the same for the grains, the likes of wheat and corn, while projecting that because of the anticipations of a record harvest, that could push down prices. And we know, for instance, the key players in the corn market, US and China, I talked about them again, the tensions. So definitely that's going to play into corn prices. Then wheat. Wheat prices are inching up. At least in the last couple of days, they've been increasing, and that's despite the fact that Russia wants to cut down on its exports. But in the next couple of months, the main factor that will still be affecting the grains market would be the forecast for increased global production. Now, for others, so for instance, cocoa, we've seen that West African countries, Ghana, Ivory Coast, they're cutting down on output production, and that is what is pushing up prices. Sugar, on the other hand, is also increasing. Nigeria imports sugar, and that is not good for us. And why we're seeing that increase in sugar is because of the rally that has been occurring in oil prices. There's a complementary demand between sugar and oil because of the ethanol component there. So obviously, if oil prices are increasing, it would, and more ethanol is produced, obviously, to affect sugar prices. For Nigeria's terms of trade, again, the movement in the export prices and import prices would influence how well the terms of trade are performing.
All right, thank you very much, Damila, for your time.
Thank you, Chimizi.
Damilola Kimbami is the head of research at Financial Derivatives Company. I will take a break, and when we come back, we look at revenue generation through taxes as global oil market remains volatile. Do stay with us. The House of Representatives rejected a motion seeking to suspend the implementation of the 7.5% value-added tax following the impact of COVID-19. And with the recent drop in oil prices, economic experts advocate alternative source of revenue, and taxation is seen as a good source of revenue if well structured and managed. Well, joining me now to talk more about this is the president of the Chartered Institute of Taxation of Nigeria, Olajumoke Simplis. Thank you, madam, for joining us on the
Good
show.
morning.
Good
Thank
morning.
you.
Good morning.
Thank you
Well,
for
the country
having
is
me.
faced with a scenario of sharp drop in oil revenue. To what extent can we fill the gap with tax revenue?
We've been talking about it for quite some time, and I'm happy that even as we speak, the institution of taxation is waxing stronger. So I believe that is where we need to look at the structure of taxation, because our revenue is not it. So we look at taxation, and how do we look at taxation in this auspicious time? We need to also be sensitive even to the companies that are going to be paying the taxes. We need to look at what have they done, who have contributed, what can we give them in return for what they have done for us. How do we encourage them to do more? Like the companies that are paying highly, how do we encourage them to continue to deepen that payment, to strengthen their structure so that they don't go down with this crisis? So taxation should be it. Now we are also looking at a situation where government should give more to encourage. As an institute, we are saying, okay, remove the issue of minimum tax. You know, the Financial Act also said minimum tax should now be 0.05%. And we are saying even that should be removed so that you encourage the companies. We are also saying, yes, we have given enough in the Financial Act 2019. Okay, we can still give more. Because as we go on, nerves are frailed. Companies have lost a lot. So in driving taxation, we need to be sensitive. We need to use persuasive measures, not aggression. We need to engage the taxpayers in a very friendly manner. We need to give them the succor to know that even as we give, we expect more from you, and what we get from you, we are also going to plow back. So that also accounts for responsibility on behalf of government.
Yeah, now, how much of palliative should tax authorities actually give at this time, given that, well, the government is looking for revenue?
You have to continue to give palliative, because the foundation is shaking. You need to strengthen that foundation. This period will go. This crisis will go, and it is only the strong that will survive it. And how can the government strengthen the people to survive it? That is, for now, they are in difficulties. Encourage them. So give as much palliative as possible. And the banks also should come in to say, okay, you took a loan and we said, okay, the paying structure is starting from January. And because the company was optimistic in January, the company said, okay, yes, we will pay. But going down the line 6 months into the year, nothing has happened. So the banks should also now sit down with the companies to say, let us restructure your loan. And the banks I'm happy that central bank is also even coming in terms of this. Should look at the interest rates on loans, at least for now. Things will get better. Things can only get better from now. It is only those who are not prepared that will go asunder.
Well, those companies would also be looking for survival strategy anyway.
Yes.
All right. Now, the value-added tax of 7.5%, that has been an issue. A lot of people have been against it. And then just yesterday, the House of Reps is saying no to the suspension of the implementation of this 7.0. Where is CITN in all of this?
I'm happy that the National Assembly has said no to it.
Why?
I am very happy.
But you want them to show compassion.
No, compassion on value-added tax is not it.
Okay.
So let me tell you, even Saudi Arabia is already saying, come 1st of January, value-added tax in Saudi Arabia is, as we speak, 5%. It's going to be increased to 15%. Come 1st of July. Now, why? VAT is tax on consumption. That is what Nigerians, please, can you understand this fact? Nigerians should understand the fact that value-added tax is a tax on consumption.
So you can choose not to consume.
Yes, you can choose not to pay. Look at this COVID time. Did I go to ShopRite to buy? No. I went to neighboring markets. Did I take my children to outfit to eat? No. I cooked in my house. A lot of people did that. So we didn't pay. If you go to ShopRite to buy, you will pay. So please, let us get it right. Value-added tax, in fact, is the veritable source of distribution of income. Because it is those who have the money to go and buy the vatable items. Please, we need to understand this. It is those who have the money to buy the vatable items, to buy the Hennessy, to buy the champagne, to go for smoked salmon, that will pay. If I buy the smoked Titus in the market, I will not pay. Let us understand that. So please, the issue of value-added tax, in fact, I'm happy that the National Assembly, they have seen reason. It is a true source of revenue redistribution. And I'm happy that it has stayed.
Okay, now, so let's look at tax revenue to GDP ratio. Is one of the lowest in Africa. Why is our tax revenue performance so poor?
Because we are not exploiting the tax system. We are not looking at the laws, and we are not implementing it as we should. Now, look at our economic structure. Look at agric. We have other sources. We have other sources. We have sources that can give us veritable source of tax. I was listening to Mr. Adegbite this morning on minerals, solid minerals. That is the way to go. You could see that he is very passionate about it. He talked about private-public partnership, and he talked about people who are even artisan miners coming on board. That is what we should be doing. We should look at the integration. Look at the integration of our other sources of income. Agriculture. We should look at agriculture. The value chain in agriculture. The raw materials that we export. Why are we exporting our raw materials? Raw. We can refine our raw materials. We can repackage our raw materials before we export them. Cocoa. Why are we not producing chocolates? I was growing up in this country when cocoa industries in Ikeja there was producing cocoa, chocolates. We are here in this country when Cadbury was producing Chocomilo. We are here. These are the things we should be doing. We should be looking inward. Look at cassava. The value chain in cassava can produce ethanol. We can produce starch. We can produce industrial materials.
And you can
Pharmaceutical.
tax
Yes, we
those
can
things.
tax those. Pharmaceutical materials for sale. We need to look at all these structures. This will create employment. From employment, we get taxes. The state will get taxes from employment. Companies will pay taxes because they will be producing. I'm happy they're talking about gold and our reserves going into gold. That is the way to go. I think this government is getting somewhere.
Okay, now let's look at the issue of multiple taxation. The business community, has been complaining about this phenomenon. What's your take on it? That's a big issue, really. And perhaps that's why a lot of businesses are finding it difficult to really meet up their obligations in terms of taxes.
Now, when you talk of multiple taxation, let me explain. There are some charges that you pay that people mistake for taxes. They are not taxes. Taxation is specifically what is stipulated in the laws. Nothing added, nothing taken off. But you will also know that the local governments have their levies and charges.
But how do you streamline those?
It is statutory for them to collect. It is statutory. It is statutory for them to collect. But what the Joint Tax Board is doing is to streamline those levies and charges. For example, Lagos State has streamlined its levies and charges to just maximum 10. And that is what JTB is doing. JTB is the Joint Tax Board. Minimize all these charges. Now let me explain. If I go out and I park my car and I'm asked to pay, it's a charge for that service, for the provision of that parking space. It's not a tax. If NAFDAC is going to a company to provide service, and because of the provision of that service, the company has to pay a fee. It is not a tax, it's a fee. If environmental ministry goes to a company to examine the environment of that company and say, okay, for violating environmental laws, you will have to pay.
Now, but what about the issue of company tax, education tax, withholding tax, import tax, excise duty, ports levy, automotive levy, ECOWAS levy, rice levy, all sorts of levies?
Those are taxes stipulated by law. They are taxes stipulated by law. It must be paid. You can't add to it. The law is law. You can't add to it and you cannot subtract from it.
So how does the CITM partner with government, on tax policy matters?
You know, we are the one that control the profession of taxation in this country. And we are not just for government. We are not just for government. We are also for taxpayers. We are for our members. And what we do is, taxation is a living subject. When we look at what is happening, not only in our climate, also internationally, we interrogate it. We interrogate it. For example, the issue of stamp duties. As we speak, our technical department is interrogating that issue. And by the end of today, we are sending our report to the Joint Tax Board. So we interrogate issues and then look at it and send our position to government. Most of the amendments to tax laws were our brain work from the Institute. We call, when we identify such things, we call stakeholders meeting. We hold town hall meetings. Okay, Manufacturers Association, SCCI, let's talk about this. What do you say? Then we take, the communique from there and then look at it and package it, send it to government.
All right, thank you very much, Madam, for coming on the show. I'm sure it's a conversation that we will
It's
continue.
continuous. It's
Yeah, that we have to
continuous. Yes,
continue
it's
to talk about,
continuous. Yes.
particularly now that the oil price seems to be um,
Thank God.
plummeting. Oh, yeah.
Yes. Now we can talk about tax.
Taxation, right?
Yes.
Another way to go. But they
Yes.
just have to find a better way to really structure it so that businesses won't die paying
No,
taxes.
that is what we have said. We have said that we should now partner businesses and talk.
Right.
Persuasion.
Okay, thank you very much, Olajumoke Simplice is the president of the Chartered Institute of Taxation. And the National Insurance Commission has extended the deadline for insurance and reinsurance companies to meet its new capital requirements to September 30, 2021 from December 31, 2020. The Commission also said the insurance companies must meet about half of the capital requirements by the end of December 2020. According to a circular to insurance companies, the incidence of COVID-19 pandemic has made it difficult to proceed with the 31st December 2020 recapitalization deadline. The review of the recapitalization deadline, therefore, became imperative in order to mitigate likely negative consequences of the pandemic on the exercise. The Commission hereby extends and segments the recapitalization process into two phases. 50% of the minimum paid up capital for insurance and 60% for insurance shall be met by 31st of December 2020. Insurance companies are required to fully comply with the approved minimum paid up capital not later than 30th of September 2021. And NICOM says insurance companies that failed to satisfy the requirement minimum paid up capital by December 31, 2020, may be restricted on the scope of business that they would transact. Their life and general insurance companies were asked to shore up their existing minimum paid up capital from 2 billion naira and 3 billion naira to 4 billion naira and 5 billion naira, respectively, by the end of December 2020 and meet the final minimum paid up capital requirements of 8 billion naira and 10 billion naira each by the end of September. Okay, let's move over now for Wednesday's market review. I have Temple now. Well, Temple, NICOM extending the recapitalization deadline. I'm sure that could be good news for insurance companies. Perhaps that's why they are gaining lately.
Absolutely. That's one of the, I mean, that sector in the market actually has one of the best performing stocks, some of the best performing stocks in the entire market after Name It, which is a pharmaceutical company. So if you ask me, this just sends a very, very positive signal to a lot of investors, the PEs, that's the private equity firms, that this capitalization thing is not ending. I mean, it's something to go on. We understand that the 30th of, or 31st of December 2020, by then, a lot of the insurance companies are expected to have hit 50% at least of their capital requirements in the market. But generally, yesterday we were up in the market. So the all share index was up at, up by 0.10%, and that translates to 12.8 billion naira in terms of addition to what you have in the equity capitalization of the Nigerian Stock Exchange. Look at the volume of transactions, volume of what we did on Wednesday compared to what we did on Tuesday. It's quite negative, down by some 7% yesterday, and that's because of the reduced level of activities in the market. I should also add that we had a bit of a 0.95 times decline in the market breadth performance yesterday. Of course, Name It has continued to blaze the trail in the market. It was up by about 10% yesterday. It's doing 120 plus now year to date, below its or higher than its year opening price. Look at the value of transactions, way higher by some 16% alone yesterday, thanks to 1 billion naira from GT Bank. You also had 2.1 billion naira from Dangote Cement. You had Nigerian breweries also contributed another 2 billion naira to the state of the market. If you look at the performance of the sectors, banking sector was down. Consumer goods sector of the market was also down. Industrial good giants like Dangote Cement, as I said earlier, was also down. It was down marginally by some 0.3%. We have Mr. Tajuddin Olayinka, who is a stockbroker with Valmont Securities, joining us on the phone this morning. Thank you so much for coming on the program, sir. But talk to us about the negative break that we saw in the markets yesterday. What does that signal about the momentum that we've seen in the markets lately and the sentiments of investors?
Yeah, basically, what that is saying is that the big buyers, those who have been putting pressure on the market to move up, are willing to slow down, at least to slow down the prices of those securities so that they can buy at their own preferred prices. So what is happening is the buyers are actually dictating the pace. They don't want to go above a level, and it's not that they don't want to buy more. They still want to buy more, but they don't want to go above a level. So they slow down the market to ensure that those who still have can also come out and sell to them. That's one point. The second aspect of it is that those who also bought previously, who had it at lower prices, are also taking advantage of profit in those securities since they are more speculators. So they are taking advantage of the fact that the prices are up, and let them, whatever it is 5%, let them take out of it. So that's the other thing there. But the basic thing is that anytime you see liquid stocks or big cap stocks slowing down,
yes,
it tells you that the buyers, the most liquid investors, those who have the cash to buy, are slowing down the tempo of the market so that they can buy more at their own preferred prices. So what we are having basically is buyers dictating the pace, wanting to buy securities at their own preferred prices. That's basically what is happening. It's not much of a problem at all.
And it's not out of place to have such a sentiment in the market. Profit taking is one of the necessary evils in the market. Mr. Olayinka, thank you so much. Mr. Tajuddin Olayinka is a stockbroker and, of course, a capital market analyst with Valmont Securities, tradable, and a member of the Nigerian Stock Exchange, I should say. Thank you so much. Chimeze, that's it.
Thank you, Temple. Well, we'll do an opening call to London as well as the debt and currency market when we come back. So hang in there. Well, we'll start off this segment from the debt and currency market, and Temple is still there. Temple.
Oh, well, thank you so much, Chimeze. So, debt and currency markets yesterday, we saw the bonds markets experiencing a bit of a mixed bag. We know between the demand and supply end of things, there was a bit of a parity, 2 basis points yesterday. We know there was interest around the 15th of July 2021 paper, which you have right here. And of course, that did, there was more demand on this particular paper, and that pushed up the price to 109.97, 109.97 kobo actually. That's at the secondary end of the market. It was actually up by some 17 basis points yesterday. Then if you look at the 26th of April 2049 paper, that's at the longer end of the curve. It was also, this experienced a bit of a rise in yield by some 6 basis points or thereabouts. Now we know that here at this point, a lot of investors actually reduced their holdings at this point, more of a retail reduction in holdings actually, and that depreciated the price to 119 naira 83 kobo. We know that the 2050 paper, which was opened at the auction recently, also continued to generate some interest from investors. On the NTB side of things, 13th of May paper has been seeing some bid-ask sentiments. A lot of local players and some retail investors have also been coming in and out of this particular paper. Generally, at this side of the market, investors have been indicating interest around the short end of the curve. And for the OMO end of things, we understand there's an OMO auction, open market operation auction today. Right here yesterday, just 33 deals was what we had, and of course valued at 137 billion naira. And let's now get an insight on all of these from Chukwudi Nwaokeke, a chief dealer with FSDH Merchant Bank, who joins us this morning. Thank you so much for joining us on the program.
Yeah, good morning. Thanks for having me, Temple.
Great. So we know that system liquidity is very, very positive at about 507 billion naira or 570 billion naira. Where are dealers and treasurers looking to channel these funds to today?
Well, we've seen system liquidity average over 400 billion during the week. We expect that to, like you said, to increase further today. By another 155 billion maturing at OMO. Well, the only place to channel these funds will be the securities, nothing else. We'll have the T-bills, then we also have the bonds, as demand is expected to remain in the government securities.
So today we have an OMO auction from the CBN, and of course there should be some maturities. Talk to us about that.
Yeah, we have 155 billion maturing today at OMO. CBN is offering 70 billion across three maturities: 82 days, 173 days, and 341 days. Until the stop rate comes out, although we expect that to drop below the last stop rate, the longest ones closed at 9.9. We expect that to drop further today. That should affect the market, as we expect some demand sentiment to be sustained as we've had for the past couple of trading sessions. We expect that to continue into today, as the money has to be plugged somewhere.
And if we want to look ahead and look at the secondary markets tomorrow, how will the auction of today shape the performance of the secondary markets tomorrow, especially at the OMO end of things?
Yeah, once that OMO auction result comes out, which we expect to drop below that, that will force traders' hands, and we expect some scramble for more securities in the market. System liquidity is expected to remain high. CBN is just offering 70 billion, with markets well over 500 billion. That shouldn't cause any major dent in the liquidity, as money market rates also remain low at 2% and 3% for OBB and overnight. So we expect that demand to continue into tomorrow.
Right. Chukudi Nwakeke, Chief Dealer with FSDH Merchants Bank. Thank you so much for your insights. We appreciate it.
Thank you.
All right, Chimeze, back to you.
Temple. Well, for updates from the streets of London, here is Juliana Olainka. Hello, Juliana. Good morning. Well, three ex-chancellors, Alistair Darling, George Osborne, and Philip Hammond, have warned of severe unemployment ahead, suggesting that unemployment could reach levels not seen since the 1980s. But did they proffer solutions to help government mitigate this?
Well, no, they didn't really offer solutions, but their experience, their wealth of experience, if you think that their experience in the Chancellery goes back more than a decade, is exactly what the Treasury Select Committee wants. They were given evidence yesterday as part of a wider look into how the government has responded to COVID-19. There were differences in what they were thinking. Alistair Darling, who was the Labour Chancellor of the Exchequer alongside Gordon Brown as Prime Minister, believes that we've entered into lockdown too soon. He thinks that there's a chance of a second wave, and that is more important than trying to restart the economy. George Osborne, who was the Chancellor under David Cameron, the Conservative Chancellor, believes that this is about time. He doesn't think that the recovery to Britain will be as bad as the 2008 financial crash. He actually said that he thinks history has taught us that a recovery after a pandemic is pretty rapid compared to what you get with a slow, painful recovery after a financial crash. And then there was Philip Hammond, who was Theresa May's Chancellor, basically saying that it's too soon to estimate what is going to happen. But I believe they were kind of all in consensus in thinking that the unemployment could indeed be as bad as the 80s, because, of course, that furlough scheme, the government retention scheme, is coming to an end in October. And there are fears that some firms, once that scheme ends, will not be able to pay their staff.
And the owner of Frankie and Bernie's plans to permanently close up to 120 restaurants, with almost 3,000 jobs losses expected. Why such tough decision by this restaurant chain?
Unfortunately, Chimeze, it's COVID-19 and the pandemic, and just how painful it's been in some sectors, particularly the hospitality sector. Although we are starting to see some of these lockdown measures being eased at the moment, for hospitality, we're not expected it to come back for well over a month. And even when it does, if we don't have a vaccine, then those 2-meter social distancing measures will still be in place. And Frankie and Benny's, quite frankly, can't do it. They've written to staff in an email saying that when measures are going to be eased, they will not be opening their 120 stores. This does affect thousands of staff who at the moment are on furlough. Frankie and Benny's does own a few chains. They also own Wagamama, which is a pretty popular restaurant here in the UK. And they also own Garfunkel's. Now, we're expecting some Garfunkel's chains to also be affected by these closures. But at the moment, the statement says that Wagamama will open as usual.
All right, Juliana, we'll leave it at that and expect more update from you later in the day. And with that, we draw the curtain on today's edition of the program. Thank you for watching. I'm Chimeze Obi Iwago.